we are joined by William Foster. He's joining us from here in New York. He's vice president at Moody's Sovereign Risk Group. Thank you for joining us. He also, by the way, is a former senior advisor at the U.S. Treasury Office of International Affairs. William, thank you for joining us. As we look at these latest economic figures, and in particular the unemployment figures, and you look at the government response that we have seen, what's your thinking around the trajectory of the economy from here?
Well, it's clearly contracting. We're already in a recession, and the pace of unemployment and the losses of jobs and the unemployment rate going up is the fastest we've seen certainly since the Great Depression. Just to put it in context, in terms of the pressures we're seeing, you mentioned the 4.4 million job loss this past week, and over the past 5 weeks, it's about 26 million. We created about just over 22 million after the global financial crisis, and from November 2009 onward. So we've already surpassed in job losses all that we've gained in the past 11 years. So the magnitude of the job losses is historic. And the response by the government needs to be equally, if not more historic. And that is what we're seeing. I think the pace at which the U.S. government is moving forward with fiscal stimulus and the aggressiveness of the Fed has been unprecedented. We have about $3 trillion worth of headline fiscal stimulus in the system right now, which is about 14% of U.S. GDP. And that would be unheard of, even during the global financial crisis when you compare the two. So the pace of the job loss is absolutely severe. We're going to have a serious contraction in GDP this year. The government's doing all that it can, but it's only going to help mitigate some of the damage because the shock is unprecedented.
What do you think of the idea of perhaps sending up to 80% of people's salaries directly to them from the U.S. Treasury and saving some of the gunpowder that's now being thrown at getting businesses through this to an infrastructure bill or rebuilding the economy after this passes?
Well, I think ultimately the objectives are similar. The design obviously would be different. I mean, fundamentally, we need to support households, especially the most vulnerable, which then will feed into consumption, which is the key pillar of the U.S. economy. 70% of GDP growth, our GDP is based on consumption. So, whether that comes directly from the government or through jobs, ultimately it's the same objective. I think the other question, though, is really how do you ensure that small and medium enterprises, which provide 50% of jobs in the U.S., don't go out of business? How do you prevent bankruptcies at the business level? Because that would be permanent job losses when we're looking after this shock, after we get through this. What will the landscape look like? What will the employability look like? What will the job picture look like then? And we want to ensure that the jobs are there once we get through this.
William, the model of the U.S. has been different than that of other nations. I mean, we've seen quite a lot of variability, right? Here in the U.S., we're offering forgivable loans to small businesses. In Europe, for example, in many nations, they're just paying employees outright, the government directly. What do you think about the effectiveness of the different models? And do you think that we're doing it the right way here in the U.S.?
Obviously, each country has to work within the political framework that exists. The key for these measures is really to be as timely as possible, to be targeted, to focus on those that need the help the most vulnerable, and to ensure that it phases out once that need is no longer there, so you keep the costs down. I think the U.S. is working within the framework that we have politically. Other models in Europe and other countries, obviously, they work differently. We could explore that here, but I think right now, trying to start kind of a new model would probably be challenging. We need to work within the framework that we currently have.
Makes sense. Speaking of models, though, something that has kind of shifted amidst all of this is the thinking that there is such a thing as too much debt here in the U.S. on a sovereign level, right? That you have to throw unprecedented stimulus at this. It doesn't really matter how much it is, right? And I found that shift kind of fascinating here. I'm curious about your thinking around it, and eventually, will it affect U.S. credit, or does it not matter anymore?
Well, it certainly matters. The real question is, at what point will it matter very, very explicitly in the markets? And obviously, right now, this is a global shock. All countries around the world need to step up with fiscal stimulus to mitigate the economic damage that's going on to in each country and limit the shock to employment. But there needs to be a plan after the fact as to how you're going to get to debt sustainability. How are you going to minimize those deficits in the future? Because at some point when interest rates start to normalize, for example, in the US, we're obviously at historic lows. This is unprecedented. The cost of borrowing is really low. So that's understandable. But at some point, interest rates will start to rise. And that's when you have a higher level of debt to pay that debt service. That's going to be even more costly. And what that does is it create every year, the US government has to pay that debt service. And the more that goes up, it crowds out other spending on things that the everyday taxpayer would like to see, like infrastructure, welfare benefits. So there's a cost-benefit analysis to the whole thing.
Yeah, a good point. William Foster, thank you so much for joining us. He is the Vice President at Moody's Investor Service. Thank you. Appreciate it.
Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.